Hello YouTube, welcome back to another Ravit Insights financial modeling video where we tackle financial modeling techniques and building financial models and looking at specific ways of building financial models for specific line items. In this particular set of videos, we're going to tackle inventory and delve into the layers of complexity of inventory. So we're going to start with dollar amounts of inventory and then look at how the dollar amounts of inventory flow through the three financial statements, the profit and loss, balance sheet, and cash flow. And that's purely the focus. We just want to understand how the flows work in the model. We might look at the timing impacts of certain inventory items, but the main thing is looking at how the dollars flow through the financials. In the next video, we'll look at a bit more detail. So we're going to break inventory out into some drivers. So looking at units and prices, how to build up those units and prices, and then have that release in time. And then in the final video, we'll add another layer on top where we'll look at manufacturing. So it's inventory where you're purchasing purchasing ingredients and then adding to that through a manufacturing process. And it's often looked at as inventory work in progress. So I think we mentioned this in our work in progress video where inventory needs to get added, there's value added to the inventory, and then once that's complete, it's finished goods that are recognized and then sold, and the cost of sales is recognized on the units of sale. So that's the staging of this. This is a good place to start if you've never touched inventory before. If you have and you want to look at a bit more detail, feel free to jump on our other videos that deal with the more complex inventory. If we preface this, a few ways of looking at inventory would be a wholesaler, for example. In this could be this example, it could be just dollar units and prices. So a wholesaler just buys inventory, builds up the inventory, sells it, and then there's some cost recognition that goes towards the sale. There might be some freight to bring the inventory in, but for simplicity, it's buying goods, selling those goods, and recognizing that through the financials. Now, if we delve into this, we've got our example financial model. If we start with looking at the financial statements, we've got just our revenue and expenses. So that's not enough. We need our cost of goods or cost of sales to give us our gross margin for our inventory. We also need a balance sheet item for inventory. And on top of it, we'll need a few other items to allow us to forecast those inventory movements. So if we get ourselves our base amounts pieces, so you'll see we've got a bit of a module suite for inventory or a base starting point for inventory. We've got our amounts cost of sales. So this is the cost of sales that we're recognizing. We've got our inventory purchase amounts. So this is the component for that deals with the inventory, builds up the balance and corkscrew for the inventory. So the opening, the additions, the release or recognition, and the closing. We've got our cost of sales where we map. So mapping our inventory back onto our financial statements or our P&L in this case. And we now need our P&L items. So the cost of sales, gross margin, we need the balance sheet inventory item. So let's build that in our financial model and get ourselves the statements that we need to get ourselves going. So if we just quickly jump into our annual financials, just a review, we've got revenue, we've got our cost of sales, we've now got a gross margin, so revenue less cost of sales or cost of goods. And we've got a balance sheet inventory that will track how much inventory we have on hand. If we start our model by labeling our items, so we've got our revenue, our cost of sales, and we need to label our inventory as well. We can also deal with creditors later, but let's just keep it to the base for now. So if we if we jump onto our working capital and we focus on our inventory section, if we do a quick run through. So what we have here is our cost of sales. So this is the recognition of cost of sales. Now we're keeping this simple. There's no units. It's just as soon as we have recognition here, it's assumed that the revenue's been made, we've delivered on it, and we're just recognizing the cost component. We're not going to put revenue just to keep the financials simple for now. We can add them as a next step, but we're just purely focusing on the cost of sales component and the inventory that attaches to the cost of sales. So first thing we need to do is make sure that we allocate our cost of sales forecast item to this inventory balance. So what that's done is we're now making sure that any cost of sales forecast is drawn from this inventory balance. So if we just start, let's just go into October as a starting point. We're going to look at 10 grand a month of cost. We've got our error to remind us to make sure that we map our forecast to the relevant revenue and cost of sales line items. So if we jump back in here, we'll quickly see that we've got 10 grand a month of inventory, of our cost of sales being recognized. That's drawing down from our inventory balances, and you'll see that the corkscrew is creating a greater and greater negative because we've not purchased any inventory in order to make these cost of sales occur. So if we quickly jump onto the P&L balance sheet, we've got our cost of sales coming through, and we've got our inventory balances, the negative inventory balances building up over time. And because these two are balanced off, we don't have a net cash flow movement from all of this activity. Because keeping in mind, cost of sales is purely the recognition in this case, and our inventory, we're not purchasing any inventory, we're just building up the recognition, the negative recognition. As soon as we start purchasing, we'll start seeing a few funny items move, like GST, where we actually pay for GST and then recoup it or get it reimbursed in our usual BAS cycle. So let's start building that up. Now, if we keep this simple, different companies will purchase their inventory in different ways. If we look at different ways of building up cost of sales and purchasing inventory, it just depends on the business. They'll have different purchasing cycles. Some might purchase quarterly in advance to build up the inventory to sell. Some might order just in time. So let's do a basic example where we purchase, let's say, just in time. So if we purchase 10 grand to meet our 10 grand cost of sales exactly, there's no revenue component yet. We just want to focus on the cost so we can isolate the changes. So that our P&L hasn't changed. It was still 10 grand. What we do see is now our cash is going negative because we are now actually creating a cash flow because we're purchasing. You'll see that it's actually 11 grand a month and not the expected 10 grand a month, because that includes a GST, so the tax that you pay in advance that gets reimbursed. We have no revenue component to match that off for now, but it's easier to isolate impacts like this. So we'll see that there's 10 grand in cash payments that occurred. Separately, there's a grand, so 10% in Australia is being paid as well in advance for the GST purchase. And then through the standard recoupment, so our BAS or business activity cycle, we then get a refund. It's 2 grand here because that's the net amount of the payment of 1 grand in Jan, as well as the refund amount. So, if we jump into our taxes and focus on our GST, we can see this. So our GST amount that gets created every period, which is the grand for the 10% of 10 grand that we've that we pay for every month. And in Jan, we have that same amount, but we've got the refund of the $3,000 that we paid for. So super simple. We've got zero inventory created because we've essentially buying it as soon as we sell it. Obviously, if we're making sales, we should get revenue, and then our cash wouldn't go negative. But again, it's easier to visualize this in isolation. So if we then look at the next point, or looking at another scenario, if we have a business that purchases in advance, so for example, maybe a quarterly purchase cycle, we'll know that there's a $30,000 or $30,000 inventory requirement by the time you get to December, and you might purchase that in advance, so in October. So you'll see that we purchased $30,000 worth of inventory, we've sold 10 in the month, that leaves us with 20. And then the next period, we started with the 20 because we haven't made another purchase. We've sold 10 and we're left with 10. And if we look at the financials, again, profit and loss through all of this hasn't changed. What has changed is now we've got $33,000 where we previously had the negative 11 because we've purchased the $30,000 day one. We've paid $3,000 or 10% in GST. So it's easier to see in the cash flow. So we've got $30,000 in payments for the actual inventory that we purchased. We've got our movement in GST payable. So we've paid the $3,000 in GST, and we're going to recoup the $3,000 also in that January period. And as you see, we've purchased 20, purchased 30, used up 10, used up another 10, and now we're back at zero. So this is purely just to see how we flow the various purchases through the financial model. Now, there's a lot of ways that you can tackle how to automate what the purchases look like. So you might build it so that you can automate the quarterly purchasing. So look forward 3 periods at the cost of sales, and then purchase that and have a time delay or a time shifter to allow you to change the periods to look forward to. You might look at inventory days. So there's quite a few methods for looking at that. We won't necessarily spend time in this video to delve into it. We're purely looking at what in and out of inventory looks like. So again, to reiterate, we've made all these changes. The cost of sales has not changed at all because it's $10,000 that it's the cost of our sales every month. We're not looking at the revenue component yet. In this particular example, we purchased in advance for the quarter. So we've got 20, 10, and 0. So we've purchased enough to meet our sales forecast for the quarter. And then we need to purchase again. So we can do it in January, or we can pre-do it in December. But let's just keep it consistent. Let's just purchase another $30,000 just so we can see this cycle occur in a few periods. So yep, again, we've got 20, 10, 20, 10. We've got our $30,000, $30,000, our $3,000 of GST paid, net to 0 in this period because we've got the $3,000 and the 3 refund. As you'll see, the $3,000 here occur. So GST is really just timing, and it's probably similar for other jurisdictions. It often is just a timing. So, when you pay it, when you receive it, it is important from a financing perspective because, you outlay the GST in advance and you collect it 2 to 3 months, depending on your cycle. So these are things to be aware of because 10% of your cost of sales is not a small amount that you can just ignore. All of this adds to working capital, adds to the cost of growth and growing your business. So just to recap our changes from this video, or all the impacts that we've had to see how inventory impacts on the financial statement. We see that there's a P&L impact. That's the recognition side. So how much we're recognizing out of our inventory to onto our P&L, what that means for our balance sheet if we order inventory in different cycles, and what that means to our cash position, as well as seeing that on the cash flow statement. So the cash payment for the inventory based on our ordering. So these are some key items to look at on the financials when modeling inventory. Now, remembering we can drive our inventory in different ways when we get to it, but understanding this basic flow is actually quite important. And one final item before we close out the video would be to look at supplier terms. So yes, we can add revenue and see the impact on the revenue. It doesn't touch the inventory balances. It will obviously create a profit position, which will also impact on our cash. But again, to isolate purely the inventory and how it interacts with cost of sales and purchases, because remember, cost of sales is just recognizing a purchase that you've made and allocating to the inventory. What we're going to do is let's just look at other impacts like timing. So for example, if we look at our creditors, so inventory should come through our creditors section for payment. We're going to allocate, in this case, we might just give our accounts payables a name, so accounts payable. We're going to look at allocating that accounts payable or the purchase into our account payable. Now, you can see in our accounts payable, we've got 33 grand for our purchases because it represents the tax inclusive or the GST inclusive amount that needs to be paid. Now, if we get a quick snapshot, in October, our cash balance is negative 33,000. It assumes that we've paid for the inventory or the 33,000 straight away. What we're going to do is let's just delay that timing. So let's just push it to 30 days. So, 31 days. So October 31, yep. And essentially what we're doing here is we're allocating our inventory purchases into, on average, across 31 days into November. So you'll see that the balance on our accounts payables gets created. So if we jump on our financials again, our cash balance is 0. So it was negative 33, but now it's 0 because we've got supplier terms now. We can also see on our cash payments our positive 3 grand and our movement in GST. So the positive 3 grand reflects the fact that we now have our movement in inventory. So the 20 grand that we have recognized for sale. We've got the creditors that have afforded us payment terms of 33 grand. And on top of it, the recognition of the 10 grand. So what's left over is the tax component. Because we haven't paid, that's why net no tax has occurred. But we do need to be able to recognize, so we've got this movement of a GST that we are now owing. So if we're on accruals basis, we're now owing this GST amount, and our creditors are 33,000. So you'll see that this amount nets out and gets cleared out in the following month when we make the actual payment. Another way to look at it is in our tax section. So we've got our inventory of 30,000 that was created. We've got our, in this case, we're using cash, but if we change this to accruals, we'll find that we've got our 30,000 that we recognize. We've got the 3,000 that relates to the 30 that is now payable in the period. And because we're not actually making any payments, we need to bring that onto the balance sheet. So This is why we've got our -3 in GST, we've got the 33 in payables, and that gets us to $0 in cash or cash movement. So yeah, as you see, as soon as you add timing to this, it adds a layer of complexity. So yeah, it's just another impact that we need to be aware of. So, by delaying supplier payments, we haven't made a payment until future periods, but we still need to balance the balance sheet, because those are now payments that need to be made in future. Anyway, hopefully that's been a good introduction to inventory and how the dollar values of inventory work through the financial statements, the profit and loss, the balance sheet, and the cash flow. In our next video, we're going to delve into how to actually drive some of these inventory values. So we'll look at different methods of building up these dollar values of inventory. So it could be through purchases of units. We'll then have a release of those units through sales as well. So we'll take more of a look at how the revenue also impacts or plays into the whole mixture of selling inventory. Hopefully this video has been insightful. You've learned a thing or two about inventory. Give us a like. Any comments and feedback, would love to hear it so we know how to improve on our content. And yeah, tune in for the next video. Thanks for watching. Until next time.